Everything in accounting builds upon each other. So we're going to recall those assumptions we went over in our first video on the accounting equation. The time period assumption assumes that a business's operating cycle can be divided into time intervals that will help us determine how often we are reporting financial statements. But not every business follows the same schedule or accounting period. Some don't even follow the calendar year. For you, the year may end December 31st at the ball drop, but for some businesses that run on a fiscal year, their year ends after 12 consecutive months starting on whatever day works for their business. And then other businesses don't even follow the calendar or the fiscal year. They let their sales determine their natural business year. For retail stores who are affected by the seasons, their sales when they're at their lowest is going to determine when their year comes to an end. Some people ask why we don't just account when money comes in and when money goes out. Instead, we do all these tedious little steps, and you actually can account this way. Cash basis accounting will record revenues once that cash is actually received, and expenses will be incurred when that cash leaves the company's wallet. This form of accounting reduces to a simple cash receipts minus cash payments. Then the tedious accounting that everyone seems to just love is accrual-based accounting, where revenue is recorded when a service or product has been delivered, regardless if the business has earned cash for it yet, and expenses are matched to the revenues they helped earn. Accrual basis accounting may be a lot more meticulous and nitpicky, but it's also a lot more transparent about a business's performance, so don't shy away from this type of accounting just because it's a bit more work. Let's go back to those accounting periods we said could be either annual, semi-annual, quarterly, or monthly. Not every transaction is going to start and end in the same accounting period. It might spill over into the next. So for that, we just have to adjust. To record an adjusting entry, it takes 3 simple steps. So look at what an account's current balance is and figure out what it is supposed to equal. That difference will be the adjusting entry for those accounts that you need to record. Deferred expenses or prepaid assets are things the business pays for in cash in advance of incurring the expense. Your prime example is prepaid rent or insurance for the year. You pay upfront for the rent for the whole year, but you're not actually using all the rent at that moment. You're going to use it over time. As time goes by and we use up that rent, we need to decrease our asset and we need to increase our expense that we have now incurred. I want to know how much my rent per month was so I know the value of the expense I incurred, assuming my business's accounting periods are by the month. The total that I paid for my rent divided by the number of months I'm paying for will show me the price I am paying per month. I use 1 month's worth of rent, so that is the value of my expense and how much I'm crediting my asset. So we increase our rent expense with the debit and we decrease our prepaid rent with a credit. Accrued expenses are expenses that our business incurs before it pays for them in cash. Your best examples are salaries that your employees earn for working but have not yet been paid. The adjusting entry for this scenario would look like a debit to your salaries expense and then a credit to your salaries payable because you owe that compensation to your employee. If the accounting period came to an end before your employee's payday, you would look at what their total salary is and divide it by how many days they're being paid for. In a work week of 5 days, if my accounting period ends Wednesday but they get paid Friday, that was 3 out of 5 days they worked, and that is the money they earned and that my business owes them. So I multiplied 3/5 by the salary to show what portion of their salary they already earned but yet have not been paid. Unearned revenues or deferred revenues were things that the business was paid for in advance to actually delivering a product or a service. A customer pays in advance for something, but as the accounting period comes to an end and you have not fulfilled the entirety of that obligation, you need to record for the portion of the revenue that you did earn from what you did do, and then you need to decrease your liability by that much. If you were paid in advance for consulting services for the month, but your accounting period ends in 15 days, you need to debit your unearned revenue by however much you earned in those 15 days and credit your revenue by that same value. I would take the money I was paid for in advance and multiply it by the fraction of what I already provide. In this case, it would be 15 over 30 because I worked for 15 out of the 30 days I was paid for, and I earned that revenue for those 15 days. We also have accrued revenues, which is revenue that your business earned but has not yet been paid for in cash. When journaling for an accrued revenue, we're going to debit an asset and we are going to credit a revenue. For example, if I was hired for a beauty consulting service for whatever that may be for 30 days, but my accounting period comes to end in 15 days, I need to record for the revenue that I earned in those 15 days at the end of my accounting period. Let's say my consulting service will cost $2,400, so I'm making $80 per day I work as a beauty consultant. For 15 days that I worked until the end of my accounting period, I earned $1,200 worth of payment but will not yet be paid. That sounds like an increase to my accounts receivable, the money I'm expected to receive at the end of my consulting service from the customer. So I will debit my asset account and I will recognize that accrued revenue at the end of my accounting period. So once these adjusting entries are made, we're going to take our old unadjusted trial balance and we're going to tweak her a little bit to show the new debit and credit values, and we're going to create our adjusted trial balance. The adjusted trial balance is your greatest tool for making your financial statements. You start off with your income statement to see if you have a net income or a net loss. From there, you take ideally what would be a net income and you deduct your dividends, and then this is going to be reflected in your statement of retained earnings. And you prepare the balance sheet last because retained earnings is an account within your balance sheet under equity, but you only get this value after you've done the income statement and then the statement of retained earnings. We will have what is known as temporary and then permanent accounts, but only permanent accounts are going to follow with us into the next accounting period. So what do we do with our temporary accounts? We can't just get rid of them because they have a balance, so we need to close our books. So what counts as temporary? Your revenue, your expenses, your dividends, and your income summary are going to be your temporary accounts, and these need to be closed at the end of the accounting period every time. So then your asset, your liabilities, your common stock, and your retained earnings are going to be your permanent accounts that will not undergo the closing process. If I'm going to close an account, then I need to make that balance zero by canceling it out. Your income summary is a temporary account that transfers your revenue and your expenses into your final retained earnings. It will summarize your income from that accounting period. Start off with your revenue accounts that have a normal credit balance. So to cancel them, I will sum up all the revenue I made that accounting period and debit revenue and credit income summary. Now my revenue accounts are closed. I take my expenses for that period and I sum those debit balances together and I credit my expenses. My income summary right now is a credit balance to reflect my gross profit, but my expenses are going to take away from that value, so I will debit income summary. Now I want to take this income summary balance and transfer it to my retained earnings. If my business turned a profit for this accounting period, then my income summary will be a credit balance, and to close it, I will debit that account. I want to move that profit over to my retained earnings, so I will increase this account with the credit. If my company made less money than expended, a net loss, then my income summary balance would be a debit balance, so I would close this temporary account with the credit and debit my retained earnings. Last bit in closing our temporary accounts, and this is only valid if you choose to pay out dividends to your shareholders. Dividends have a normal debit balance, so they will be credited to close the account, and our retained earnings will be debited to show that payout to our shareholders. This process only applies to temporary accounts. You do not apply this to your permanent accounts. Like, you wouldn't want to cancel out your cash account at the end of each accounting period. We come back to our trial balance, except now it is post-closing and will show only permanent accounts with their balances after all closing and adjusting entries. You are only going to see your asset, liability, common stock, and retained earnings accounts on this trial balance, and the same rules of debits equal credits still applies. So all those processes we just learned, like journaling and posting to the ledger, which we learned in our previous video, and then adjusting entries and closing process, all play into what is known as the accounting cycle. The accounting cycle is going to be repeated each accounting period with the same steps each time. First, you'll look at your transactions, or the fancy term, analyze. Then you'll record that transaction in a journal entry. All journals are posted to the ledger, and then the ledger accounts are compiled into our unadjusted trial balance. As the accounting period progresses, we will make adjustments and then reflect these adjustments in our adjusted trial balance. That new and improved trial balance will help us make our financial statements, and then we get into that whole closing process. Our trial balance makes one more comeback for this cycle when we make sure all of our accounts are balanced in the post-closing trial balance. Since we talked a good deal about income summary and finding out if our company worked on net income or a net loss, let's figure out how we calculate for our profit margin, a good way to measure a company's results. Your return on sales is computed by dividing your net income by your net sales. Your second ratio is your current ratio that will show your ability to pay short-term liabilities. So divide current assets by current liabilities. A ratio greater than 1 means your business has a bit more wiggle room to pay back its current obligations, and this is a good sign. Adjusting entries in the closing process definitely need practice, but they get a lot easier with the more practice that you do. So go down below to study with my free downloadable study guide and practice with my free worksheet. And don't forget to subscribe for more future mini lessons on accounting.